Ladies and gentlemen, welcome to the Daily Capital Flows live stream where we are covering every single macro driver in the US economy and every other major economy in the world and focusing on what are the major asymmetrical bets that we can take within that. So, appreciate everyone joining today. If you are brand new to the Capital Flows live stream, we have a bit of a new format that we're putting out every single day, and I'm going to walk you through it. And in the breakdown for today, we're always going to have a main section that is all focused on active risk takers. So if you are in a place where you're actively taking risk in markets and putting real capital to work, and you recognize that you want to know how those investments can be aligned with the biggest drivers in global markets. That is what these daily live streams and the connected reports that we have go through every single day. And the focus that myself and James have are finding asymmetrical bets that allow you to outperform. That is just so critical because if you are in a spot where you're just trying to hold a diversified portfolio of a bunch of different stuff, that's totally fine. But if you want to have returns above the benchmark, it requires additional work and inputs to make informed decisions so that you have a better risk reward. And so if you are in one of those spots where you want to know the macro regime, especially navigating recession risk, something we're going to talk about today, inflation risk, macro liquidity, the credit cycle, and be able to have a clear view on rates, FX, US equities, so that you can know when to press risk and when to get out of the way. And at the bottom line, you make capital allocation decisions and you're responsible for risk, not just opinions. Then this live stream is structured specifically for you. And so in the section that we have for today, there's always going to be a free macro playbook where we'll cover all the first principles for how macro flows works, what's actually driving markets, how the structural regime is developing. This will be really key with Kevin Warsh that we're going to talk about today. And then we're going to filter through some of the narratives and institutional biases that exist that we would say, hey, you want to analyze those and ask some hard questions so that you can say, why exactly do people believe what they believe? How are people misunderstanding markets? James can talk to this a little bit, but in today's world, with how fast information was moving, it used to be in the past, if you just knew information before other people, you could have a massive edge. And I think there's still an element of that. However, one of the largest edges now is recognizing when people misunderstand information because information just flows through the cycle so fast and you're still actually trying to see people catch up with that because they don't really know how to orient themselves. But now it's all about what are the most misunderstood factors, not necessarily, oh, do I have a piece of information that no one else has, but how am I interpreting that information in a way that no one else can? James can actually speak to that a little bit because I think that's a big change that is taking place overall in the market.
Yeah, I agree. I mean, we've talked about this a couple times about how we think that we're sourcing the truth properly by being on Twitter and finding truth in these new ways that everybody in the financial world just doesn't get. And I feel like we aren't realizing, or most of us aren't realizing, that it's just a new form of propaganda and it's guiding us, I think, even more effectively into traps in different ways. So I think, what we try to do every day is kind of question everything we've been thinking, how we look into the future, how we're deciphering, how we're thinking of the present, and try to think of like unique and different ways to move forward to gain edge. And ironically, sometimes that's leaving the screens for a while, right? Setting aside some time to think and ponder and just let the creativity run wild. So I think we both kind of really leaned into that recently while also trying to stay in the absolute trenches. And I think it's a tough balance, but I think if you kind of keep doing that and keep grounded in this stuff that we show here, the foundational aspects of the price of money, I think we're set up for success moving forward.
Yeah, I agree. My entire focus every single time, because there's a lot of different people who have different goals in markets. Some people are just trying to outperform a benchmark. Some people are just trying to have low volatility returns. Like there's a lot of different people in the market. But when I winnow it down and I say, okay, but what am I trying to accomplish? It's very simple. It's having clarity on the macro regime and conviction in asymmetric bets. If I can accomplish those two things, then not a lot of other things matter. And so the entire live stream today is meant to provide all the free educational material. And then in the private members section, that will be for paid subscribers. This is the kind of new section of the live stream where, we've been doing live streams for a while now, for almost the entire year, I guess. And we're still going to provide all the free stuff that we've been providing every single day. Now we're going to have an entire section that goes over the proprietary research that I have, that I pulled together from all the models and strategy that I have, that maps global capital flows, the macro regime, positioning, and systematic flows, all going through every single line item. And then in the paid subscriber section, we'll go through the live Q&A. You'll get and walk away with a proprietary macro report so that you can get the bottom line takeaways of every single thing. If you don't have all the time to join the macro live stream, then you can just go download this report. You'll also get a recording of the private live stream and a um, transcript of it. And just to go over it really fast, the report that I did yesterday and the live stream we did yesterday on compute is the new oil. Every single day there'll be an article that's sent out that has the recording of the free version, the deck that James went over, the PDF that I went over. So all the slides that we go over today, you'll be able to download that. And then you'll have tomorrow's live stream linked here. And then there's a paywall right here that you guys can't see. But if you open this in your own thing and you're not a paid subscriber, there'll be a paywall right here. You can go through the proprietary report, which is right here, how compute is the new oil, what that even means, how to actually apply it, how to quantify it, what are the models you need to do, and then the full recording of that right there. So that's the format that we'll have every single day. And if you become a paid subscriber, then you can get all of the breakdowns that exist in the private members section. And so if you want to be able to do that, all you have to do is wherever you're watching this, there's going to be a link below in the YouTube section, or you can go to the Twitter bio. And this entire live stream will not stop at all. We'll go all the way to the paid section. It'll stop streaming on Twitter and YouTube. And then the rest of the paid section and proprietary section for paid members, we will go over the rest of that. And that's really where we synthesize everything. So, what I would say is if you're at a spot where you're just trying to get the big picture and learn a little bit here and there, then perfect. Stay with the free section. You don't have to go to the paid section. Just learn as much as possible, especially if you're like a younger individual who's in college or something like that. Just go through the free playbooks every single day, join the live stream every single day, and we're going to cover so much stuff that's going to be incredibly valuable. And then once you're at a point where you're saying, okay, you know what? I'm actively taking risk. I need to understand all these factors that are synthesized, how it connects to markets. That's when you can become a paid subscriber. And even if you don't have a ton of time, again, that's why you have the 20-minute report that goes out every single day that synthesizes everything. You can take the transcript of the live stream, throw it into an AI, ask it questions. Everything is set up so that whether you have 20 minutes or the 2 hours for the live stream, everything is made incredibly simple for you so that you walk away with clarity on the macro regime and the conviction and asymmetric bets that you're taking. So that's the entire goal of the Capital Flows live stream. And so the promise for today and the main idea for today in the free section that we want to cover is by the end of this session, you'll understand any nominal yield breaks down into real growth and inflation expectations, and then how the forward curve prices the Fed's reaction function, and then the mechanics that drive any single rate move reverberating across stocks and bonds. What does all that mean? The entire idea is that if you are operating in markets and you come in any single day and you look at the tape, if you look at where we're at, you want to look and say, where are we at with stocks and bonds and currencies? And, I'll just go over a kind of easy breakdown right here on what that means exactly. When we come in every single day, and I'll let James kind of speak to this for himself, I'll look and I'll say, okay, where are we at? Equities basically flat to down in the day. The Russell is actually up compared to ES and NQ. So we're probably seeing a little bit of rotation where you're having selling in tech, a little bit of a bid in the Dow and the Russell. So it's telling me we have a little bit of rotation, not outright selling pressure. Bonds are up on the day, and then bonds are not just up, but the curve is flattening a bit. So that tells me a lot. And then I want to look at bonds and the interest rate curve across every major country. I can see, okay, the dollar is down against the euro, the pound, and these other currencies. Crude is down, pricing less geopolitical risk. Again, this is if you guys have been joining the live streams for any period of time, you have known that the entire playbook has been as soon as oil falls, equities are going to hit the bid so hard. You're going to have a little bit of a Goldilocks impulse, and things are going to shift pretty significantly. We're going to actually expand on that view today and break down how some of the things have actually changed around that because that's what we were talking about up here basically and right here. If you go back in the live streams, we were talking about it's very likely to oil move lower, and once that begins to move lower and make a bottom, you're probably going to have gold and silver bid, equities bid as well, and you're going to have some things shift in the forward curve, especially as we move into FOMC. Now we're down here. And you shouldn't think the same way about oil down here as you did up here. You need to update your view. And so that's one of the things that we'll be covering. But when you look through the tape, you can see gold and silver, they're marginally up on the day. Bitcoin up marginally, but we're about flat off the lows. Hyperliquid has just made a new high today. If you've been following us, again, the largest bet that I have had and in markets is being long hyperliquid, and specifically the expression of that is per. Uh, you know, been long since these sub $3 levels, and it continues to be my largest bet that I hold. And here's a great example of asymmetric bets. Most people, if we're up, let's see what the exact percentage is. But when we're at this 350 level or sub 350 level, we're up, 200% from basically where we initially laid out the view and pitched it. And I talked about how it's a really significant opportunity. What a lot of people do, and again, this still will depend on individual situations, but most people in the financial industry have a lot of vol constraints where even if you have a name go way up and you have this big parabolic run, hedge funds have to stay within positioning limits. So they have to actually sell their winners once their winners become too big of a part of their portfolio. And if this single position in my portfolio moves around my portfolio pretty significantly, it's the largest position I have. And so especially once it rallies significantly and it's now at a high, that begins to move things around in a way that you might not have experienced before. And James can talk to this about how you go from these small moves to now you have these much larger moves, even though you're up on your cost basis and you're protecting your principal. And that is going to put you in a situation where it's very new if you haven't been there before. And so the largest bets that we have right now is Hyperliquid, and the expression of that is per. And then also Oracle, which here's the risk reward I originally shared. We continue to be on sides from when I originally shared it right here. We sold off on the earnings announcement that took place, kind of deleveraged a little bit. I shared that I'm just continuing to bid calls. I bought a lot more calls, yesterday and last week, and it continues to be the one most mispriced opportunity in the entire AI complex, in my view. So those are the two large asymmetric bets that we've been laying out for a while. Everyone kind of knows about them. There's more bets that we're going to begin to share as they begin to develop, and we're going to be sharing those in the paid subscriber section that will be, kind of breaking those bets down further. James, maybe talk to this a little bit before we keep going about thinking about these larger bets and what it's like to go from, oh, now the largest position I have is up 200%. What do I do here? How do I think about this?
Yeah. I think it's something we should probably I'll have to think about like writing more on a little bit because you're taking bets that are very asymmetric and have a lot of potential wound up in them and you're normally taking them at a point where the vol hasn't expanded yet. right? You're kind of taking them when nobody else is interested, or maybe it's in an accumulation zone and volatility is compressed. So when it starts to work in your favor and volatility expands, which is theoretically what we want, especially if you get a per gamma squeeze, right? It could go crazy expansion. You're not if this isn't something you're used to and you're just mostly allocated in your 401k or whatever it may be to VOOs or Qs or whatever, you're not used to violent intraday swings. So because of that, you don't really have the nervous system reps to deal with the ups and downs. And that's why we get a lot of people that come in, they take this bet, they think, oh, it's a macro guy and he's taking this bet. It must be a safe macro play. And then they get a 15, 20% multi-day downtrend and they're like, WTF, this makes no sense, this is stupid. Well, it's it's part and partial to exactly what we're talking about here. The volatility is now expanded, and if you want to be the one who gets paid to be the pig in the end, you're going to have to learn to start to stomach and ride the roller coaster that is the volatility through the network growth of things like a hyperliquid or a per or whatever. So it's not easy. I still struggle with it, and that's why I take and add to positions a little differently than somebody else will who can hold their whole position because they love risk and they love volatility and they've had it a lot in their life. So you got to start to think like about where you're coming in. We talked about the narrative arc before. Where are you entering on this trade and why? What are you used to? What are you not used to? I'm sure a lot of people watching right now have learned over the last couple months what it's like to ride a volatile trade and they haven't done it before maybe. So really interesting thought experiment, and it's like good to get skin in the game even if it's small, just to start feeling that wild extrapolation that starts to occur.
Yeah, I think that it's definitely interesting. I mean, it doesn't really impact me now, but I have my own, or the sharing things publicly doesn't really impact me as much anymore. Sharing views or stuff like that. I think that when I share something publicly, it's kind of great because to me, it's almost like being able to play a sport in the middle of a stadium, right? Like when you do something wrong or it doesn't go the way that you wanted, like all the haters get super loud, which I love because once you make your comeback, then you just suck all the oxygen out of the room and you can't hear anyone, which is like perfect. So I just like the entire process because my entire strategy has zero to do with what as soon as per was down a little bit, and here I'll go back to this chart. As soon as per was down from the highs a little bit, I had every single kind of person coming into the comment section telling me about this and positioning, head and shoulders, hyperliquids going to, just every single, reason under the sun about why it's a horrible bet. And that's where if you don't have conviction, if you don't know what the drivers are or why something is happening, then you can get shaken. For me, I already know what's driving the stock. I've modeled it, with a lot of precision because if you want to take large asymmetric bets, you got to be precise and you have to be right. And there's if there are definitely scenarios where if something happens, I take off my risk without any input or anything else. Like the entire timeline has nothing to do with my risk decisions. It's not an input into it at all. So I think, it's just one of those things where your conviction is going to get tested, and if you don't know what is backing your conviction, then if you really think you're going to do well in the moment when things are the most chaotic, then you're really overestimating your own abilities, right? You're saying they have way more discipline and skill than you really do, and it's probably just going to set you up for failure. Whereas if you say, hey, you know what, let me come onto the live stream, let me write down notes, let me spend time being intentional and thinking through these drivers, asking really informed questions, and building out my own thesis so that I can make an informed decision. So I can be the one who controls my own decision making. And I'm not frantically looking around for someone else to take the responsibility for me. And I think that just occurs on every level. For risk, it makes it really explicit, but even your own learning and thinking, which is what we're kind of going to cover today when we talk about nominal yields and breaking them down into real growth, inflation expectations, how does that connect to the Fed? If you understand these factors, you are going to understand more as Kevin Warsh comes out tomorrow and gives his speech than most people in the market. And I'll explain why. Let's start with how exactly interest rates work. When people say interest rates are going up or down, the first question you should ask is it inflation expectation driven or real interest rate driven? And on the Substack, you can go through all the educational primers. If you're brand new, just go to the educational primer section, go right here on the main page, click on this. It has a full suite of educational primers on every aspect of macro markets. Here's an entire list of models that you can download yourself. And there are primers on interest rates that you can cover. And so when we talk about how interest rates work, nominal interest rates, the headline number that you see every single day when you go to TradingView and you say, okay, let me put in the US 10 year. Yes, this is the time series that you are seeing. This is the chart that you're seeing. But you need to ask, what is driving it up or down? Is it growth or is it inflation? Is it equities? Is it FX? Is it a carry trade? What is it exactly? And fundamentally, interest rates for nominal interest rates always get broken down into two things: inflation expectations and real interest rates. If you can understand both of these, that will set the stage for everything else in your own thinking. And let me go to this slide really fast. And by the way, this entire slide deck, if you really want to dig into this more and understand things, it'll all be available afterward on the website. So if you're a subscriber, this entire PDF breakdown will be sent to you and you'll have this. You can go over it yourself. Here is a nominal rate attribution for the 2-year interest rate. So in white right here, you have the 2-year interest rate. And then in blue and then orange, you have the drivers of interest rates of the 2-year. And that's really where you begin to differentiate yourself, right? If you don't even know where nominal or real interest rates versus inflation expectations are driving the outright rates, then you're probably completely misdiagnosing why rates are moving the way that they are right now. And at the end of the day, it's the same thing if you're analyzing a situation, if a doctor is diagnosing a patient, if you can't diagnose them correctly, you're never going to be able to find the answer. It's just not going to happen. And so here in the chart, you can see that we'll give you an example right here. During 2021, you had the inflation expectation component be the primary driver of interest rates to the upside. And you can remember that the Fed in 2021 allowed inflation to run above target. And that's why you had inflation expectations rise so significantly. And the initial rise in 2-year interest rates was partially connected to the Fed, but the primary driver was the inflation side. Then, as we moved into 2022, inflation risk on the orange right here began to normalize and it began to move in a range. And then you'll notice here in blue, real interest rates, primarily for short end interest rates on the real side, it is the Fed saying, do we want to hold rates above or below expectations? So here you can see that the inflation expectations in orange actually are beginning to put downward pressure on 2-year nominal rates, which is why you have us making these series of moves in a range right here during 2022. And what you had is inflation began to fall, but the Fed held rates at an elevated level. Basically, 2022 in 2-year rates is the flip side of what the Fed did in 2021. Now, this period of time that we're in, post 2024, is about threading the needle on either side, meaning that 2021 was an extreme where they let inflation run above rates. 2022 was where they put rates above inflation and just held it there so that inflation would come down. Now, since 2024, they have been trying to thread the needle and manage both sides of inflation risk. That's one of the reasons why rates moving up have not really caused an equity bear market, because if you understand this new regime that we're in where you're threading the needle on either side, then you can begin to say, okay, now I understand that the Fed is actually having a more restrictive stance relative to 2021 and also not as restrictive relative to 2022 and 3. So all of these factors begin to frame when people kind of come up with these extreme views about, hey, I think inflation is going to move to all-time highs and we're moving into the 1970s. You could say, well, hold the phone. Is that in accordance with the Fed stance, or is that kind of just a cool idea that might sound like it will hit a headline? And then on the flip side, people are saying, okay, well, we're moving into a recession because the Fed needs to cut rates. You just say, hold the phone. If that is true, why is it that the rate attribution is not dragging interest rates on the long end down? And this comes to this chart that I want to share with you, which is explaining, if we have interest rates here, nominal interest rates and the drivers of them, they're driven by inflation expectations or real interest rates. Then we need to say, okay, well, what's the difference between short end rates and long end rates? And fundamentally, at the end of the day, short end rates are primarily driven by the Fed's policy decisions. Long end rates are driven by long term nominal GDP, which nominal GDP is made up of not only inflation, but also growth. So it's both growth and inflation. So if the Fed is too tight, if they raise short end rates too high right here, the opposite reaction that is going to cause is that it is likely to cause nominal rates to move down. If they're too loose, nominal rates will move up on the long end. And so short end rates are always what the Fed is doing in their policy. Long end rates price if the Fed's policy is too loose or if it is too tight. That is the main idea that you want to take away from what we're covering today. Because if you can get these two ideas of, okay, rates are driven by either nominal or by either inflation expectations or real rates, and then we have short end real rates and long end real rates, excuse me, nominal rates. Then once we begin to connect that to where we are today, you are going to be able to understand the entire situation that Kevin Warsh comes into. And even if Kevin Warsh hikes or cuts, and this is something we're going to cover in the paid subscriber section, what is the implication of that given where we're at with long end rates or with how the curve has been moving? And so here's another breakdown of how nominal rates have been functioning. So here's year to date. And here is when 2-year interest rates went up. And you'll notice in blue in white right here, when 2-year interest rate went up, it was primarily driven by what? Inflation expectations in orange. This is when oil was going through the roof. You can see that it was primarily driven by inflation as opposed to the Fed trying to be overly restrictive in itself, which is why the curve is actually flattened a bit. And if you don't understand that, it's okay. We'll cover it a little bit more in the paid subscriber section and connect it to how to think about some trades into FOMC. But now notice right here, the move that we've had is inflation has come back down in the driver and attribution component, but real interest rates are still putting upward pressure for the 2-year, which means that there is a bit more of a tension as Warsh takes center stage tomorrow. And if inflation or growth plays out in a certain way, it's going to be really key to understand as Warsh makes these decisions. So these are the factors that you want to be thinking about when you're talking about nominal interest rates, especially as we move into FOMC, because all of these little things frame the bigger picture ideas of what's going to happen with how Warsh tries to play things out. And so, um, you know, James, I kind of want to dig into it a little bit more, but any initial kind of things that you want to add to that and really kind of share from how you think about trading bonds, trading all of these different order books in the rates complex over the years.
Uh, well, for me, I'm like always kind of thinking about the steadiness of the bond market and kind of just like how is the short end moving in comparison to the long end in the futures markets, and like what is their liquidity looking like? What are the players looking like? And for me right now, I can't show it, but behind that screen over there, I have all of the bond markets up, and I'll usually look through them day after day and see Is there any actual like order book edge I can sense in these things? And if not, I then use them more as a litmus test of kind of the strength or weakness of markets. Are they moving a lot? Are they moving a little bit? How is the like is the 2 year moving but the 30-year staying still? Are they both moving? It gives me a good feel for how that's gonna like emanate throughout the rest of the markets. I personally am still trying to understand kind of all of this kind of, we go from inflation expectations and Fed policy into nominal and real and the rate of change and how they're kind of pressuring on each other. That's where I'm starting to still try and wrap my head around. And I think that's why I show up, I show up every day here. But honestly, I like to look for confluence between kind of the regimes we're talking about it here and then looking into the actual order books to decide whether or not do I want to be positioning into bonds or am I just going to want to use them as like a thermometer of things out there?
Yeah, I think that's really good. I think one of the things that we discussed is that even if I'm not running a trade in bonds, knowing what bonds are doing is going to inform any other trade that I take. And it actually makes me a better trader at every other thing. Because, for example, if bonds are not moving and we begin to have a pullback in equities and bonds are not really responding to the change, or I'm seeing a certain curve regime in bonds, then I know, oh yeah, this is probably a dislocation and not a macro driven move. And I actually want to fade this in equities because bonds are doing X, Y, and Z. Most people don't really think like that. They're just like, well, there's a dip here, maybe there's a level in ES. Let's just see what happens and buy some calls. I don't really trade that way just because I always try to find the most asymmetric bet that I can take, be incredibly precise in how I express it, and know exactly what I'm doing so that I can size up and really clearly define my risk. And maybe I'm going to be wrong. Maybe I'll lose the money. That's fine. I just like to be as precise as possible and have a very clear understanding of what's taking place so that I can be able to take that bet that I want to take. Or else, you know, then you're just going to be batting singles all day and maybe you'll make money, maybe you won't. But then, at the end of the day, it's going to be hard to have those. It's really the big trades, it's the home runs that are the differentiators for everything.
Yeah, I think it's super important to. This is where I go back to my order book stuff, but like I think it's super important to at least understand what an order book is and to have some sort of DOM, like disaggregated order book, like somehow on your screens somewhere, whether that's book maps or whatever. Just Google it and find something that's available for free. But being able to start staring at the order book movement, you will over time start to realize, oh man, these things are moving or they're not, because it just gives you this internal heartbeat of markets that you just can't see on trading view. Like you just can't tell me that seeing it go, oh, we're plus 30 bips or we're now minus 5 bips. Like you don't understand how it got there, how it felt on a candlestick chart as much as seeing an order book whip around. So if you guys haven't explored that, I would highly suggest doing it. And down the road, I actually know some people that are building some products in relation to this, given all the tools now. And I think we'll be able to highlight them here more. So I'm pretty excited about that.
Don't tell them all the cool stuff before it comes out, James. Come on.
Alpha.
Yeah, one of the things that I think is interesting is I on the order book side, um, I think it gives you this multi-dimensional view of price that you wouldn't see with just the time series and volume, right? That you would just see on TradingView or any other charting software, whatever. And then I kind of think about macro in a similar way, right? Because we're like looking at these attribution analysis and these drivers, the underlying drivers of like the headline number, right? And that's where I really like stacking these edges because if you can begin to have a more specific interpretation of the drivers and rates and things like that, and then stack it with, oh, and then this thing is happening in the order book, that's when you can really find, pretty significant edge. And that's when I think things get really interesting.
So let me ask you a question on. I thought that was a really good point you made where, like, all right, hey, we're moving down in equities. Maybe there's some violent rotations going on. Volatility is spiking up a bit. yet bonds aren't really responding, or credit's not really responding, or whatever you want to look at as your litmus test of like volatility expanding outside of the VIX. Like,
Right.
would the opposite be the case then, where what if bonds start really moving and those ranges start, like the average daily ranges are starting to expand, you're starting to see more players in there, maybe feel a little bit more of emotion, but stocks and maybe the risk assets aren't really moving that much, would you start to actually get a little bit more warning bells as to be like, wait a minute, the bond market's starting to wake up and suggest something? Would it be the reverse in this case?
Totally. I think on both sides. Let me share this chart, and we'll kind of go through two scenarios that I think will be really helpful for how I think about trading this, because I think about one, trade expression, and two, like what are the signals around that. Here's just a chart of the S&P and also TLT. These are just two ETFs everyone knows. And here you can actually see in post 2018. We talked about this drawdown yesterday. If you weren't here, go watch the live stream recording from yesterday. We broke all of this down. But what you can see here is that equities are bidding out of the 2018 lows, right? Because the Fed basically says, oh, no, we're not going to hike. We're going to pause into this. We're actually going to bring cuts back on the table. But notice right here that TLT begins to move up right here in the candlesticks. And notice that it begins to make a series of higher highs. And then only when it begins to tick up here, then equities begin to pull back. Now, notice right here, TLT begins to hold this level, but then equities mean revert back up, which I would always, typically expect until you have, if you have, ES or SPY begin to, reject these levels, make a lower high, and then bonds make a higher low, that would begin to send some warning signals. And you can kind of have a front row seat of that by overlaying some vol, call skew, put skew, and then also some order book stuff that we've talked about. But notice right here how bonds hold these levels, equities make an all-time high, but notice that bonds, they don't mean revert back down, which tells you, oh, there's actually some persistence in the drivers right here, which means that if TLT breaks out right here, and again, we're using TLT as just a broad proxy, right? Like we would use rates, we go to the forward curve, there'd be a lot more stuff to do. But just notice that then once you begin to break out, equities begin to fall. And that's when you want to say, okay, maybe I don't want to get bearish equities. I still want to buy dips in equities, but now maybe I want to run some longs in bonds or be long stocks and bonds together. And that's really where you can get creative because, again, most people think about trading as like day trades, which is like great, but it doesn't require, I think, the level of like creativity that you can have where you can structure some of these trades and say, okay, how do I be long stocks and bonds so that I am kind of having more optionality in these different scenarios, right? Because especially if you move into COVID, if you were long stocks and long bonds and you had your bond portfolio, you could actually come out neutral, right? You could come out not as cooked because you could sell some of your bond position, sell some of your equities, come out flat, and wait until vol comes down and then hit the bid and put on size. That's actually why, like COVID, stocks went down, bonds went up. That that was obviously scary for people overall. But the reason why 2022 was so much worse was because the stock bond correlation was positive. Both moved in lockstep, which means that the people who held a 60-40 portfolio of stocks and bonds down here had lost more money at these lows than they did at the COVID lows. So you didn't really see this all the time, but like people were freaking out, especially who held like a diversified portfolio because this period of time right here was almost more scary than COVID, right? And so those little things, and we're going to actually have a chart of stock bond correlation and how it connects to where we are right now. All these little things add up to begin to say, okay, just remember, you're not trading against some day trading Twitter bro on Twitter, right? Like that's not your competition, right? Like, especially on an intraday basis. There are massive,
Whoa, 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 man! Be careful out there. There's some great traders. Okay.
of course. No, no dude, we're all on Twitter, okay? But there are such large funds that are hitting the bid, hitting the ask every single day, all day, and it's across stocks and bonds and currencies. And there's not, it's actually funny. I've actually had a couple of people talk about it where I used to share like intraday trades on ES on like my Twitter thing just for like fun because I was like getting bored, which probably means I wasn't working hard enough. But like, I would share those, and then I started having people from the crypto space say that I was like um, trying to front run and rug people in ES, and I was like, oh, I'm
They got you. They
I'm
got
I'm
you.
uh, I'm the one. Me and my small Twitter account are the ones manipulating the stock market. Got it. Got it. That makes tons of
Yeah.
sense.
Did you respond with "My size is not your size"? That's like the best way to do it.
So I
Real quick before you move on, can I ask you a question about
go
this?
for it. Yep.
This is really interesting because I didn't really I didn't even meet you or start focusing on any of this stuff until after 2020, right? I traded
Right.
through 2020. I was a pure scalper, right? Didn't care, long, short, whatever. Can you scroll back into the lead up to 2020 with
Yeah.
the TLT and SPX there? Um, and then, if you don't mind, also putting up the 2-year bond. Just like when I'm looking at the run up or thinking about the run up to COVID, because I never did a proper debrief or understanding of the run up there, right? And when I look at you have TLT as the main one there, right? The
Yes, that's the
okay.
candlesticks. Yep.
Okay, so like that ending point is super interesting where it seems like it before COVID started to really smash, it looks like TLT kind of broke out
Yeah.
uh, to the upside there as equities were still drifting higher. And what did the 2 year also kind of break out in that same spot?
Yeah. I
Um,
mean, here, let me actually see if we can get back. And I have to like
I
see.
say this because like there were people that were macro studs back then that to me like they always have told me that was a layup trade. Like it was so easy to get positions on. Like the volatility was so low in stocks, like you could just kind of get your stuff placed. And now looking at
Right
this, going
here.
back, this is like the first, yeah, this is like the first time I've really seen like that TLT breaking out, right? Like this, obviously, this is when COVID started going around, but that's like a huge signal that I never even realized happened.
Yeah, I remember during this time. So here's like when this is why understanding interest rates and is just so critical because if you can know that this is happening and why it's happening, and then say like, oh yeah, I should probably get hedged in equities here and not get long equities. There were so many people at the time. There's actually this article. I mean, I remember talking to people. There were so many people at the time that were trying to bet against this uh, because everyone was saying like, "Oh, this is not going to happen." Like, we're not because this, the initial jitters of everything here, and then it just like took like a couple weeks before everyone's like, "Oh, wait, let's sell it." Rather, there's like this kind of like waiting period right here where everyone was just kind of like confused for a moment but bonds are breaking out and equities just sit there and it wasn't until like things really blew out and actually some of that stuff connects to positioning during 2021 things have changed a lot now but VIX expiration and OPEX were like the things that set the highs and lows in a lot of these areas in ES during the time and they were actually if you look at like VIX OPEX during like this entire period the entire run in 2021 they were like setting highs and lows, mainly setting lows, because there was so much vol premium from like all these like funds. And it actually it's kind of funny because like it worked really well until it didn't. Like buying the dips in 2021 on like the VIX expiration, and then like basically everyone figured it out, and then like it doesn't work anymore, right? Like people are still trying to like do that today, and it's like no, it's not. Like there's some premiums
Yeah, those
discount.
volatility funds that are closing shop every other month.
Right, right. Yeah. All the smart guys.
Right.
But
I
yeah,
don't know. It's just so
it's
super interesting. It's like you were saying, you could just, if you didn't want to get short equities because you weren't sure, but you could have bought bonds there and be long, long, right? So like you could be long bonds, long stocks as a way to play it, and then by a week or two later, you're probably getting out of stocks. You know,
totally.
so
I think that's why, like, um, Paul Tudor Jones, when he talks about like these different trades that he makes, so many of them, I mean, even in his recent interview, like so many of them are focused on rates and FX because like you can define your risk so much better in rates and FX, and there's so many more mean reversion opportunities. Where at stocks, you just have to really time your dips, and then like if you're going to short it, if you're going to short stocks, there's probably a trade that you should put on in bonds or FX before you short stocks. And it's just very like unless there's like a specific sector that you just want to trade the dispersion of, um, it's just very difficult to short stocks. And I mean, again, that's one of the reasons why once they finally do go down, why everyone gets unwound because again, no one wants to get short, like, and rightfully so, right? Like I'm long stocks right now. Like I have bullish position. I've been long for a bit, or for a while ever since I laid out the credit cycle playbooks that I was and like tweets and everything else. So I think that's all these different factors come together, right? And for me, if I want to fade a move, I need to ask: Do I want to fade this in equities or rates or FX, or what is my view? How am I connecting that to where we're at?
yeah, that's so good. I really love the like stacking things on top of each other, all even culminating in like the OPEX schedule there. You know, the February shit show that could always happen. September is also always a weird moment in time. It gets into seasonality. Like now we have the midterm section coming in. We have a new Fed chair that's dictating where we're going. Like all of these things are at some point going to unite in a moment, which is what I'm really excited about. That's like that's the spot, and that's where we got to go balls to the wall leverage and trust the gut, you know. And I don't think that's now. Now feels like still like risk on, everything's kind of hunky dory or whatever you want to call it. But somewhere down the line, seeing this setup here, which this is cool for me because I've never really gone back and thought about that from this perspective, is going to happen again, especially in these like parabolic eras.
Totally. Yeah, I agree. I think that there's going to be, especially this is why talking about these like when people are talking about, um if people are talking about like some type of nature in the microstructure of the market, it's probably like getting monetized right now. Like people at the middle and end of 2021 started talking about VIX expiration and trading it, and then it's like by that time it's already gone. But like that's why you need to talk about what are all the things that are not taking place right now that could, because then once you see it once, you're like, oh, look at that. Let me use that to like put on some risk right here and see what happens, right? But again, a lot of people are waiting for, well, let me see it confirmed twice and then I'll go the third time. It's like, yeah, okay. Actually, well, uh, you should talk about your whole idea and maybe share a chart on this of like the being first or third, but never second. How do you like break that down? Because I like when you told me that originally, this was years ago, I was like, oh, that makes so much sense. And like I do that all the time now.
Yeah, well, we all get stuck in the middle where like my best or my usual like example of this is just a breakout trade, right? Is I want to be like, if I'm breaking out something into price discovery and I want to be long, I want to be first into that. I theoretically want to be, I want to understand kind of where we're at in the credit cycle. I want to understand the asset class. I want to have conviction in that moving into price discovery. So I want to be long into the break, or I want to buy right at the break. And that's being theoretically first, right? Um, Third would be, hey, we're going to break out, we're going to have continuation, and then we're going to have a mean reversion back to test the level that we broke out at. And that's where it's going to entail having patience, not feeling the FOMO of the continuation, because so many of these continuations just keep ripping and lock you out, right? But if you're going to be the guy that waits for the retest, you could be third, position yourself cozy. You could probably have really limited downside risk. But as we all know, a lot of us get chokehold in the middle there where the break happens, it starts to continue, and then we kind of just arbitrarily get long. And then we don't have as much defined risk because we're probably going to be risking all the way back towards below like the breakout level as the support, right? So now your asymmetry in this trade is a lot worse because you have to put up more risk uh, to get an equidistant amount to the upside, and you're going to probably go back and forth on your conviction once it does start pulling back. So for me, I always want to be first. It's like, again, do you really like if you're going to get into a fight, do you really want to be on the back side of it? Do you really want to have to always be on the defensive counterpunching? Maybe, but like I want to be first to that punch, or I want to be kind of gaining my distance, waiting for my spots and being third, right? But you never want to be the guy that's just reacting to everything in the fight or in the markets.
Yeah, I think that's so good. Um, I'm I'm always surprised like that. Just those little things. I mean, those are little nuggets where like if you guys are on stream today and you're like listening to that, or you guys are watching the recording, like just that little nugget can like save you so much because then you're gonna look at price. You're not gonna look at it the same way. You're gonna say like, oh, now I have this like win an idea under my belt, and like you can make that idea your own, right? And you can say like, here's how I think about markets. I don't try to do this or that. I'm always here in this lane, and and then I think you get a lot more comfortable with who you are, and like you never worry about missing opportunities because you know that you're going to find the perfect setup for you as a person and not try to force another. And then you kind of understand, okay, how can I be first or third to this, not chasing in the moment, right? Or how can I moderate my position sizing around getting on sides when I'm first and then adding once I can kind of be third and not chase at the highs, right?
Yeah, and you're gonna say maybe this is new to you, but you're gonna say, well, that makes sense for a breakout, but like, what about? Well, take the SpaceX IPO, right? It's another good example. Either you wanted to be in this thing from a lower round, or you wanted to be smashing buy literally at the open, right? Because you've looked through the float schedule, you understand Elon, you understand what SpaceX is trying to do, you understand the macro regime that we're in, and we're like, this all leads to a buy to me. So I'm first, right? Or you're hands off, right? Maybe you're doing the put call, selling puts strategy like you talked about yesterday, or maybe you're just absolutely waiting. You're just okay with missing this absolute ripping move to the upside. And this is me, by the way. I'm not in SpaceX. I'm just kind of waiting around to see how this all shakes out. But maybe you're waiting for a retest of a level. Maybe you want to see if it re-explores the kind of 135 last IPO offering, whatever it may be. That's third, right? But a lot of people are probably buying above 200 now because they just see, they finally understand the float. They finally understand what's possible. They see it running to the upside, and all of a sudden they're aping in now. But like, I mean, what's SpaceX at now? Let me just jump over to this real quick. I might have to rejigger my thing here.
Here, you
Hold on
can
a
share my
second.
chart.
There we go. Well, this is just the
Oh,
1 minute SpaceX chart
yeah. Oh, cool,
here.
cool, cool, yeah.
Yeah, like again, how many people do you think saw the overnight action in Hyperliquid, right? And then the gap up this morning and said, all right, fine. I can't take it anymore. The float's super low. I just can't stand it. This thing's going to rip our faces off and bought right in here, right? How many people do you think bought in here today? It's got to be an insane amount. And they're barely hanging on for for life right now, right? But would you really be shocked, guys? Like, would you really be shocked if, like, oops, sorry, if we kind of like went down here, closed the gap, down here, maybe explored here. It's still a $1.5 trillion asset, by the way, guys, right? And then we move, and like, then all of a sudden everybody capitulates. It wasn't what they thought it was. Warsh is this, policy is that. Everybody hates Elon, and then boom, 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 it goes to 400, right? Like, it's just this is another great example of like, just be first or third and try to avoid this catastrophe that's waiting for you, right? And then you're gonna think about the downstream effects of that, right? This happens, it goes really poorly, you were second. Then OpenAI comes out, Anthropic comes out. You're like, fuck this, I'm not doing this thing. Hands off. Look what happened last time. They screwed me. It's market manipulation. The float so low, who knows what they're doing, right? And you can see how that just eats in, and eventually you stop trading and you get back on monster.com and apply for the next job.
Just put the fries in the bag, bro. uh,
Dude, McDonald's needs those shirts. That would be hilarious. You know,
I
their
feel,
stock would go up. Social arbitrage play. Just say just put the fries in the bag, bro, on their
dude,
shirt.
if I think if a lot of these fast food places became more memeable, like they're already like obviously McDonald's is already memeable, but like if they leaned into it more, people would go there just for the memes and to be like, oh, I'm going to go to this like place and take a video just to do X, Y, and Z, and they're gonna buy stuff, and then like they'll get all these like clout chasers around and not just like a bunch of low income people buying trash. You know, it's they could change the entire dynamic, right?
I totally agree, and it's like, especially with like the Chris Camillo guys, these guys that have huge clout online, they can create these narratives out of nothing. You
Totally.
just put the fries in the bag, bro, on a visor in McDonald's and tell people about it. Your stock will probably double, and
Yeah,
that's
honestly,
comical.
what I would do if I were McDonald's is I would say like, hey, like free shirt for like or free thing or whatever it is of like that memeable stuff for like every like 20 bucks that you spend or 40 bucks that you spend or whatever. Free marketing, bro. Like it just is like that type of stuff is like stuff you need to lean into. And it's like so funny to me because I've talked with people at different like companies, financial firms, just like corporations, and like it's so wild to me how behind the times some of these people are. And and then you have like this is why like I think I said in an old live stream like the person who the kind of idea that like the victors write history, like it kind of doesn't matter what happens because like if you win the war you get to write the history books to say whatever you want. And I think that like being able to Oramax and meme is what is going to rewrite history in a way that like doesn't it'll make other things like not even matter. And it's like we're already seeing that with like literally like everything online, the Trump administration, everything, right? Like they mastered aura maxing. Doesn't matter if you like them or not, right? Like the internet is like making them go
Yeah.
viral.
Dude, the
Whether
White
it's
House intern. Oh my God, so
dude,
good.
I would just hire that guy immediately if I could, no matter what he like, just just to be like, yeah, go ahead and just like teach me everything that you've learned over the last like it would be like a master class, man.
I totally agree. After this, guys, don't worry. I'm gonna go put some work into AI and figure out how we could shill McDonald's on this idea. I'm thinking, you know how they put your fries in the cardboard little thing, right?
Yes,
You know, I'm talking about like the little casing for the fries. They could shift it, make some like play on saving the planet, put it into some like organic bag, like like not plastic, but like a different material, like a biodegradable material. That's like a bag, and it just says just put the bag, or just put the fries in the bag, bro. Right? It's like a good idea. Plus, it's the meme. Plus, it's a bag. I mean, come on,
totally.
we are writing history right now for
Uh,
McDonald's.
just nothing but good ideas. All right.
Hmm.
Um, all right.
To a good point here, real quick, that the
Yep.
person on the chat said GME had people diamond handing. It's like, yes, they turned that into a meme, which created this whole movement, which moved billions of dollars. Perfect example.
Yeah. 100%. 100%. All right. I want to cover a couple questions in the paid chat really fast before we keep going, and then we're gonna keep jamming. But going back to pull up this slide on how to think about. Let me see here. Yeah, just a quick question on these bars and how to think about these bars and what this means exactly. Here we go. All right. So right here is nominal rate attribution. It's saying what is the driver of the changes in interest rates in white right here. So this is 2-year nominal interest rate. It's just the rate of change. What's the 10-day rate of change of nominal rates? 2-year nominal rates, that's white. Right here in blue, the fact that you have the inflation swaps moving down or flat and nominal rates turn positive means that the Fed is actually exerting a little bit of control. So what you need to ask is, for short end rates, is the Fed allowing the market to price what the market thinks is best and not really exerting its control? Or is the market kind of like coming in and I just kind of think about it as like, is the Fed kind of like, I kind of think about it as like, with let's not use that analogy. I'm trying to think of like a better analogy. Like basically, is it like kind of just like, has like a, like the beach ball in the pool, and you're just kind of like playing around, pushing it around here and there and letting it float around? Or is it just taking it and like putting it under the water and just holding it down? Like, that's kind of the analogy of like, who's in control? Is it just kind of like going with the flow of things, or is it actively exerting its power to change the outcome of something? That's what the nominal and real interest rate drivers are showing. That's why, like right here, when we see blue and equity still can't sell off, it tells you how strong the credit cycle is. That's really key. And so when we shift to this idea of how is this impacting equities and bonds and things like that, this goes back to the stock bond correlation that we talked about, where, this period of time in the 2010s, we had a negative stock bond correlation, which means that if stocks went down, bonds went up, or if bonds went down, stocks went up, which is very helpful for a portfolio. Once you move post COVID, the entire game flips. And bonds do not provide the same type of diversification benefits that they did in the past. And there's actually cycles of how diversification benefits function, because what's happening right now is people don't think of bonds as like this great investment anymore, because if stocks go down, a lot of times bonds have gone down at the same time, like right here, right here, right here, right here, right here. I mean, just massive, massive moves where both go down and they don't have the diversification benefit. What's going to happen is we're going to keep shocking positioning so that all the big institutional guys basically begin to say, well, maybe I should hold gold. Maybe I should buy some oil calls. Maybe I should own some Bitcoin. Maybe I should own this or that. We're going to get everyone off sides. And then we're going to get everyone net long in equities just in time for everyone to think that bonds are dead. And then we're going to flip it on everyone. That's like what I think is going to happen. And I don't know what the timing is of that, but I do know that the strategy I've set up for that will catch it when it comes. And that's really, this period of time that we're in a credit cycle melt up that is in itself unsustainable because of the type of liquidity that we have. And so understanding these bigger picture drivers are going to be the differentiating factor for how your returns function over the next 5 to 10 years. And so digging into these ideas now will be a differentiator. I linked here as well 5 papers that you would want to read on how the stock bond correlation works, so that you can understand how you want to begin to think about what are the largest players in the market thinking as it relates to stocks and bonds. And you can see, AQR has a great paper where they would talk about, the changes of stocks and bonds have broad implications for investor, either increasing portfolio risk or forcing allocations to change, likely to reduce expected returns. So there's this entire idea in portfolio allocation where if stocks and bonds don't provide the diversification benefit that you would expect, then you begin to make less money in the future. And then as a result, you might have to take less risk. And then you don't have as much money to actually retire, which actually inversely sometimes causes people to either spend less money in their retirement, or on the flip side, say, you know what, screw it, just go to all stocks and I'm just going to send it. And then when you have a portfolio correction or a market correction, those people get washed the worst. So, all of these different larger factors are all coming into play. And if you are actively managing risk in markets, if you're a financial advisor giving people advice, if you're a PM at a hedge fund or at an institution or you're on a desk, trading desk somewhere, all of these bigger picture ideas are the most important things that you can be quantifying right now. And so again, all of this entire slide deck and the entire breakdown that we have here, it lays out how to think about interest rates. We covered that you now know, if you go and rewind the video and watch the recording, you know how nominal rates work. You know the period of time that we're in with inflation expectations and how they've dropped recently. And you know nominal rate attribution. You know how the short end relates to the long end. And you can understand how we are fitting into that in the big picture as 2021 was an extreme, 2022 was the opposite extreme. Now we're really in the middle. And more recently, we had this run up in inflation, and now we're kind of seeing the opposite now. All of that connects to this idea of the stock bond correlation and how stocks and bonds, how are they providing benefits to each other? How are people incentivized to do that? And then how can we begin to connect all of this to the larger picture of what is going to change for institutional flows? So I'm going to pause right there because I want James to kind of take these ideas and connect it to we have these big picture ideas about the changes in markets, the stock bond correlation, what that means exactly. But now, how do we connect that to making really clear decisions and setting yourself up to make good decisions in that as you have all that information?
I just wanted to put this up here first. I think that's important. I think that's important to show. This is the power that we have these days in real time image generation. I think that's important given this stream here.
Yep, I like that.
Um, all right. So one thing I wanted to show you guys here is I have this dashboard for myself, which anybody can kind of. I could probably put the link out there for you guys, but I'll work on that later. But basically, I can sign in, and we have a big kind of moment coming up tomorrow. You wanted me to dive into the slide deck. Is that
Yeah,
what you were looking for, Flows?
yeah,
Okay, so um, I have this thing where like what's going on today, right? We had the SpaceX still driving the narrative. We had some import prices come in, some FOMC's first day, whatever, and we could kind of break down. The reason I'm showing this is because you got to build this mental model or process for yourself to know, hey, what did we just what just happened? What are we coming off of? Where are we at now? And what's coming down the pipe? Options expiry, like we talked about, earnings, economic calendar, just any sort of mergers or releases or news. Like you have to have all of these living in your mind and thinking about exactly how you're going to be working positions in and out and around all of that stuff, right? So I think it's important that you kind of understand what's coming down the pipe here. And tomorrow is obviously one of the biggest days of the year in a long time, where Powell is not going to be the center of attention. It is going to be Mr. Kevin Warsh. All right. And then I kind of have some market movers here and stuff. And if you remind me later, I will give you that to put into the send out for people later today.
cool.
And, we got some market narrative and stuff, but I'll stay away from that for now. I want to show you guys something else here, which is the last deck that I made. And by the way, we're also making this available. All the decks that I make, I'm putting them on this website, which will be, again, posted in the report. And you could go in there and check out all the different slide decks that we're doing kind of with the mindset stuff. And today we're going to talk a little bit about positioning into events. If I recall correctly, you generally, Flows, like to be, if you're going to be doing something with an event, you generally like to be positioning into it, right?
If I see that I can take the other side of an extreme that already exists, then I have like no issue getting positioned into an event, especially because now a lot of positioning functions that way. But I think a lot of times what we see now is it used to be that the event itself set extremes at if you could map what the extremes are in interest rates, then FOMC or CPI prints would cause reversals at those extremes. But now, actually, those catalysts a lot of times set extremes and levels 2, 3, sometimes 4 or 5 days before the event because of how hedges get put on and taken off now into catalysts. So it's very interesting I'm I mean, anyone who's trading rates or trading these catalysts or hedging their risk, they understand it really well. I don't know how much other people understand it very well though.
Yeah, I think that's awesome. I remember you always kind of finding these spots prior where we'd be at an extreme in positioning or sentiment or whatever it may be, or pricing in some sort of like too many basis points cuts or hikes or whatever into a catalyst. And I was like, oh, like that makes a lot more sense because you could actually create even more of a like sweet probabilistic outcome to the other side with even more defined risk into that spot. So that's something I've definitely incorporated. So, anyways, yeah, Wednesday is a big day, Lou Fed chair, and it's really important to think about how you're positioned to it, how other people are positioned to it, and to kind of take advantage of the information you have out there to kind of grasp what's happening as we head into tomorrow. Um, what we actually have, right, is we got so turn on a little bit of thing here. We got the actual policy decision, we have the dot plot and guidance, whether or not he guides towards dot plot, away from the dot plot, towards more forward guidance, towards less forward guidance. That's going to be important to think about. And then how is Warsh setting the narrative, the tone for the rest of the year, right? I think tomorrow is like a Super Bowl for him, but from everything that I've seen of this guy, and maybe you want to touch on that a little bit, maybe for 30 seconds of like the polished performer that Warsh seems to be.
Yeah, I think that the biggest misconception around Warsh is that it's going to be a binary hawk or dove. And I think that you have to recognize that Warsh's entire goal, not only in what he has expressed, but which is still misunderstood, I think, but also in his experience that he has had. You have to. It's actually kind of funny. People view Warsh as like this establishment guy. In my view, it's almost like how people viewed Trump in 2016, where they're like, "Oh, who's this outsider coming in and doing all this stuff?" Look, I get that Warsh was at the Fed previously. We have to recognize like a lot of the guys that have been at the Fed are like very establishment guys, whereas Warsh has been one of the very few people who has actively taken risk at the highest level in financial markets and probably understands financial markets better than anyone else in the world, maybe besides Scott Bessent. I mean, you basically have two guys in the powerhouse together. So I just think that these guys, they are, even though there's going to be constraints on Warsh, which is, they have their voting process, they have their own process at the Fed, so it's not just unilateral. We all get that. It's like, all of us know that. Tell me something we don't know. But Warsh, I believe, will like his entire job has been thinking differently about markets and coming up with creative trades to express in that. And I I just think people are underestimating the type of creativity he can bring to the table in the way that Scott Bessent and Trump have brought a lot of creativity to the table. And again, people don't like to think about that because they just don't like Trump or they don't like Bessent or something like that. But again, it goes back to people not understanding the macro mechanics of the system. They don't understand that regulatorily you can do all these different things. I mean, what happens if he works with someone to shift how the banking regulation, international regulation, swaps, like all these other levers that happen in the background? What happens when he works with Scott Bessent and with the administration, right, to be able to accomplish that? I think that you're going to have a lot of really creative solutions that happen behind the scenes that people don't really expect. Because what are they doing? They're just tracking, well, what's the Fed balance sheet at? Right? I mean, it's all priced in. Everyone knows it. If you like the entire, people, the entire central bank balance sheet, reserves, how it connects to the reverse repo, how it connects to SOFR Fed fund spreads, like all of us know that stuff. It's so like top of mind now post 2020. and it doesn't really provide the it's not really differentiating you at all. So I think there's just going to be some really interesting things that come out of it, and I'm watching for those.
Yeah. Seems like a fun holy trinity there of Warsh, Besson, and Trump working together. I'm really excited to see how this all shakes out. Um, Obviously, we spend a lot of time on social feeds and financial Twitter and crypto for a lot of us or whatever, and you're just going to see a lot of these. And remember, um, everybody wants to speak binary, speak in tails, left tail, right tail, or whatever. It's going to be, oh, Warsh sounds super hawkish. It's going to be a sell off. The dots are moving up. Long end rates are going to blow out. We won't be able to handle it. Oh, he's hit to get a cut. Risk on. Sounds like he's worried about inflation. Oh, we're going to be more or less data dependent. How is he acting? How's his body language at the presser? All of these things, you're going to see a ton of that. But it is important, at least, to start thinking about everything you hear and what that might mean for people and how they're positioned. Like, you can take their opinion, but does that suggest their bias and their positioning into one of these events? Because usually it does, right? And you got to remember, like, if you're second, if you're the reactive one, if you're letting the catalysts guide you, you are essentially going to be the reactive crowd. You are going to be the exit liquidity, right? So I like to think about, is there an opportunity into the catalyst, or is there an opportunity for me to exit if I am in it, or to take positions afterward, right? This actually is an ironic kind of uh, first or third situation here, since we just talked about this moving forward.
Can you pull up my slide really fast? I think this is
Yeah,
interesting.
let's
Like
see
we're
here.
already going into, you know, this entire setup, and we're already going to have like this is what people are focusing on. Well, how many times is he going to say inflation? 40 times, 50 times? Jobs. Jerome Powell, 77%. Trump, like rate cuts, like money. Good afternoon, right? This is what people are focused on, right? Like look at the money that's getting traded around this. So I think that's
Aren't you
just
excited that calcium polymarket have really taken the things that matter the most and given them to you for an opportunity to win all of the fiat dollars?
I feel
Come
in
on.
so much more control of my life now.
Oh my goodness. So, here's things you can ask yourself as you move into tomorrow, right? Um, what is the price action that's been occurring last week, this month, yesterday, today, right? That's why actually I posted on Twitter. We gapped up with the end of the Iranian war, right, which is still kind of up in the air. Sunday into Monday had a massive move, and I'm thinking to myself, this is the perfect opportunity. If you've been watching the days before these massive catalysts after big moves, we've had this high probability of a kind of hedging, kind of getting out of really speculative positions type of things the day before, right? So to me, I was like, what are the things that moved the most yesterday that I'm a little less convicted on, that I think are a little bit overblown to the upside, that I could take a short scalp on before tomorrow's event? I think I shorted Zcash, which I think Zcash is. I'm going to pull that up real quick. Hold on. All right. So, oh man, this is making me look good. I won't lie. I took a short in this area up here, right? Because when I was looking at the longer term Zcash chart, I said to myself, all right, well, we had this. Now, I don't mean to make it a crypto show, but it just applies everywhere. Broke down of this range, we recovered here, and now the alignment with the timing of all this, plus the thrust we had in that specific asset into Monday, I said, all right, well, this is actually a chart that's going to provide me a little bit of a resistance combined with the timing and the positioning and the hedging unwind that might occur into a catalyst like Warsh. And you wouldn't be able to tie Warsh to Zcash, but you can see what I'm doing here, right? I'm building this story. And now my scalp is on sides. I'm able to kind of think clearly about it. And I'll probably decide, am I going to get out tonight, or am I going to get out tomorrow into the presser? I'll take that as it may. But I just thought that was a kind of cool example of what I'm referring to. But other things you could look at: credit spreads, right? The fear of greed index, the commitment of traders report, volatility, expansion, contraction, whatever, put call skew. What is your own personal gut feel, and any real time positioning data that you might find, whether it's like from Bloomberg or whatever the rich people with all the information have, like global flows.
The rich
Um,
people who get poor by paying for data.
that's right. It's a stair step, two steps forward, one step back. And so remember, there's like a matrix of probabilities of outcomes here that you got to start thinking about, right? Do you feel as if after going through all of this stuff, right? Do you feel as if the crowd is long or positioned that way or bulled up? Well, if so, and there's a hawkish surprise, right? He comes out really strong, really defensively, blah blah blah. Um, it's probably going to be a violent unwind, right? If it's a dovish surprise and it's a continuation of the crowd being long, it might be a bit more of like a grind or muted or whatever. And the other thing, the crowd is short or bearishly positioned into it. Let me zoom in a little bit here. If the crowd is short or bearishly positioned into it, but there's a hawkish surprise, well, the bears are already there. Maybe there's a little bit new selling, and you can maybe have determined what you want to do from there, right? If the crowd is short or bearish, but there's a dovish surprise, that's when you maybe see the really risk on rally, and the shorts are forced to cover, and adds fuel to this move, which might help you hold on to a trade later if you're long bias, or get out of one if you're short. Right? You see the matrix of probabilities here. And you could kind of come in again, who's driving the price before and after? Is it overly reactive? Maybe it's a SpaceX situation, or is it overly institutional where it's like jobs report, people kind of positioning and hedging huge money? These are the things you got to think about. So map that range, map that outcome of the bell curve of probabilities, right? So you can see things like, hey, 25% of the time, I think it's going to be a dovish lean into short positioning. 35% of the time, I think it's going to be in line, data dependent, it just chops around. Maybe it'll be mildly hawkish 25% of the time, and maybe it'll be really hawkish into a lot of people long, and that could be 15% of the time, maybe a little bit more of a left tail situation. All right. So you got to start thinking about these and then say to yourself, what would I want to do in all of these different situations? Maybe if I'm really aligned with something with one of these outcomes, that's where I'd want to be most aggressive. And then if it's one of these other outcomes, it's where I'd want to be least aggressive, or maybe not even into the trade at all. Right. And one more thing to think about is, are you already positioned into this? Right. Are you already in a lot of positions that rely on the market continuing forward, continuing to go up and to the right? Well, then maybe you want to start thinking about how could you effectively hedge those bearish outcomes, right? Or if you're not at all and you're flat, well, clean slate. You have optionality for everyone. You could maybe enter ahead of it, or you could wait and be third and react to everybody else's reaction. All right, so kind of the same thing here. I know we are running a little bit low on time, but the idea is like you want to run through all the scenarios, talk about the redundancy planning all the time. That way, you're going to be able to effectively manage your positions, let winners run, stay small, stay big, add to hedges. Maybe you want to start scaling into an entry, all these different things. But the whole idea is try not to be second. Don't be the exit liquidity moving into tomorrow. So good luck. Hopefully that helps a little bit for you.
Yeah, I think that's really good on connecting these factors to how should you think about making decisions into tomorrow. And we're going to go over some more of that in the paid subscriber section. But what I want to go over before we transition into there is, a reminder, we just went through this entire slide deck on inflation, growth, interest rates, how to think about that from a mechanics perspective. So go through the recording, we'll go through all of this. Again, the transcript will be available afterward, so you can feed that into AI and ask it questions, have it educate you based on where you are individually. But the key idea is that every single day we are going to be going over the live stream and go over the free macro playbook. So every single day, we'll be starting at the same time, and we'll go over all the macro principles you need to know, what's actually driving markets. That's what we covered today, how the structural regime is developing. We talked about that today as it relates to interest rates and the how the 2021, 2022, and then post that have really set the stage for where we are with rates, how filtering narratives and institutional biases is really key right now. We have, obviously the main event this week is going to be FOMC. We synthesize that all together to say, okay, now you understand the building blocks that you want to know moving into the rest of this week and the main ideas to map for that. Now, what we're going to do, if you are still here and you want to go over and say, okay, I want to take all this knowledge and really synthesize it into the specific levels, specific drivers that we are seeing today, and the correlations, the changes that we are seeing today, and how I should begin to develop clarity in the macro regime and conviction in asymmetric bets. So that's going to be in the paid subscriber section. So this live stream isn't going to stop, it's going to continue on Substack. And if you go wherever you're at, click on the link that'll be linked below in either the YouTube bio or on Twitter, in my bio on Twitter or wherever it might be, then you can go to the Substack, and we're going to be starting the paid subscriber live stream there. And in that section, we're going to cover the proprietary report where we talk about the forward curve, inflation, how that's priced, what you should think about it. And we're going to walk through all of those factors so that the net results at the end of that is you have a lot of clarity on what to think about as we move into tomorrow, as we move into the end of this week. And it's going to set a foundation to make really, really good decisions. So that's what we're going to cover. We're going to take a short break and allow everyone who wants to join the members live stream to be able to go over, subscribe, go through everything. You can do a free trial if you just want to watch today and start going through all of that. But everything's going to be laid out in the premium session. We're going to start that in a minute, and we'll take a short break, and then we'll see you guys there.